Hello and welcome to Newsclick. Today we have with us Professor Mario Tonveronachi from the University of Siena in Italy to discuss the financial system and the crisis it is still in. You've looked at the financial system, you have some very strong critiques of the financial system, but do you think anything has really significantly changed after the crisis that we saw from 2007, 2009 and that still continues?
Well, not so much, because in reality there are more words than facts, and what has been made up to now, in many cases, especially in the banking sector, has been to change some things of the previous regulation, Basel II, that were distortions, weaknesses, and so on, particularly important. But this does not mean that the new regulation is strong. I mean, if the previous regulation were weak, you improve, but it doesn't mean that you have reached a new satisfying position. And after all, the approach has not changed. The approach is substantially to follow the banking practices. I make an example. Banks have to measure their own risk, internal risk, in order to know more or less how much reserves and how much capital to put aside. This is they call the economic capital. Well, our problem is the following: the regulation on banks, what is doing is to bring the best practices of the banks and transform them in regulation, which means that the regulation is going towards what are the best practices of banks. It's not the regulators do not start from a different standpoint, from a very large social, political, economical standpoint, looking at the entire society, entire economy, but they follow the practices, the best practices, at least, of the banks.
So what your critique has been is that you are really internalizing the basic philosophy that the banks are following, not really examining that, and focusing on fine measurement of risks, as you state, and not really structural problems that are there today.
Yes, you know, in a market economy, the banks make their own business. It's all right, no problem. But it is not the business of the government. The business of the government is to look at the structural problem that an economy may have, at problems of employment, welfare, and so on, growth. Okay, that is a real different matter, because it's very simple. If the regulation goes after a problem only of stability, we can also imagine that is very strong as regulations. But if it is too strong, may kill the banks in the sense of putting the banks in a position to finance the economy. So, in a sense, what I say in general, this type of regulation has not a metrics, has not a reference, analytical and empirical reference to judge how much strong, because it starts from the wrong point of view. It doesn't start saying, I want banks to finance the economy, then they must behave in this way. Okay? They start from the other point. I do not want the bank to fail. Okay, but a mummy do not fail, goes inalterate in the centuries, but it doesn't serve anything, you know.
Could ossify everything.
Ossify, mail, or leave banks to make the most grave disasters, as we saw recently, or at the opposite, they may ossify the system and doesn't serve anymore. You see, it is the wrong point of view, the wrong starting point. Look in this way at the regulation of banks.
So what you're saying is, if you want to regulate the bank, you must see what is the bank's role in the larger economy, what is the direction you want the economy to grow or go, and then look at what are the instruments of regulation for the banks to deliver that.
Perfect. That's the point.
That's the point.
And the important point is that if you start from this perspective, you reach a different conclusion from the one that they are following now. Now they are following a position in which you have an international standard for regulation. Basel is an international standard that should be adopted by every country. If you start from the other perspective, you have the necessity to calibrate your regulation to your own problems, to your own country. Okay, so it's a rather different story.
So one size shoe fits everybody kind of principle doesn't work.
That's the point.
Because the economies, the mix are very different. The other critique that you have had is that one of the things you see, in fact two things that you have said in various papers that you've written, is that one is that this micro calculation of risk, that's what is actually a mythical calculation.
Yeah.
It has no basis in reality because it does not see the system risk. It just sees every instrument risk, and this kind of innovation is a meaningless one. And in that sense, it doesn't produce the kind of outputs the society needs. And the second criticism that you also make is that essentially this does not take into account that the economies, the financial systems are all interconnected, and therefore regulating one part while letting others completely free will not solve the problems of the economy. So would you like to tell us something a little more about it?
Yeah, the first point, let's put it this way. We live in an uncertain world. That's our problem. Because our decision today depends on what we expect for tomorrow, but the tomorrow doesn't exist without our decision today. This means that, in reality, the concept of risk and the concept of uncertainty are two different concepts, because I agree perfectly that banks must in some way compute their risk. For this they use their best methodology, the best methodology they have. But they know that they may be wrong. They know that they are working on shifting sands. The problem is why the regulators adopt these methods that are not confiable. I mean, are methods that you know that tomorrow, let me explain. The supervisors, bank supervisors, must put their seal on the methods that a bank is adopting, on the data that is adopting, on the results. At the end, the supervisors say, I am satisfied, or I am not satisfied, but if they are satisfied, they say, okay, that's all right. Okay? That's all right what? a measure of risk with statistical methods that may in 1 week show that all the results you expected are wrong. As an example, in Europe, the European Banking Authority made a stress test on the bank, okay? In order to see the banks that needed more capital, that had some problems, etc. There was a bank, Dexia, that passed without problems. 3 weeks after was failed. Okay? That's the point. I mean, it's not because, or not only because, the supervisors are not good. It's the problem that you cannot put a regulation and supervision on this track of measuring risk, because risk is one thing, uncertainty in the other. The authority should put the situation in another perspective, the perspective eventually to decrease the degree of uncertainty and then let the market work.
So what you're saying is that uncertainty in some sense is something the regulators should look at to reduce the uncertainty.
Yes,
what
yes.
banks can or cannot do, what kind of exposure it should or shouldn't have. While the risk is calculating a more arithmetic issue,
And
calculating something which is internal to the bank, but does not really deal with its external interface, the real economy.
Yeah, because look at it. It's not much different from, in general, what should be the role of the state. The role of the state should be to organize the society in order to protect the society from shocks or to avoid internal shocks. Okay? It's not different. I mean, this structure that the state should require the financial system to have should be in such a way to not to eliminate, because it is impossible, but to limit the degree of uncertainty. Then we know that everything may happen. We can structure the system in order to have the less serious consequences. Okay? Obviously, if you have a mega bank whose assets are a multiple of the nation's GDP, okay, you have problems if these banks fail. If you have many independent banks, small, medium-sized banks, as in the United States in these last years, we had in the United States more or less 400 small banks that failed. Nothing happened. Okay? So it is a different way to look at the structure of the system. Okay? This is the really important difference, because in which the academics have some because the improvement, innovations in financial mathematics and statistics, it all seemed that we could measure everything, we could forecast everything. Okay, but okay, you can be wrong once, you can be wrong twice, but then you must learn. I mean, after that, the very large American funds, LTCM, failed, and it was in the committee of this there were 2 Nobel Prizes. Okay, well, okay, you must realize that this is not the right way to go on. Okay, it was a very large hedge fund that required the intervention, not with the money, but the organization for its resolution by the Federal Reserve of New York, in order not to make it fail, because it would have been a very serious general consequences. The other problem is, with this type of regulation we have spoken up to now, you regulate banks, you regulate investment funds, and insurance company, and so on. Each one with looking at, in a sectorial way, at its own problems, not looking at the financial system in general. This means that if you decide to regulate one sector in a very stringent way, but you leave the entire sector to innovate, to make new products, to make new institutions, obviously we have what we had, obviously what is called the shadow banking sector. That is, much of the activity with some innovative products are put outside of the regulated sector. Okay, it is always difficult to know how much to regulate, how much strength to put in a regulation in one sector and the other. And so the regulators are always after the things that happen. Okay, they did not see this crisis coming. Few people saw this crisis coming, but this is a problem of not having, in general, the comprehension of the system in its entirety. Okay, there are very few small and very simple things, especially if we follow some perspective like that given by the Minskian theory. The problem in the economy is debt. Okay, because you, in order to go into the future, for instance, to make investments for the future, you must go into debt. Debt means that in the future you must have enough money to pay the debt, to serve the debt. That's the problem, because tomorrow you cannot have this money, and so you have a problem of failure, the debtor that fail, the creditor that may go into trouble because he lent, and so on. It should be very simple, or relatively simple, to look at the system and see how much you are near a position in which you have difficulty to serve the debt. Okay? In reality, also the information that the supervisor, that the state should require, and we have not enough now, should be how much, related to how much a family, a firm, a bank is near a point in which it may be difficult for it to serve the debt. If you see that the point is near, you must intervene. Something rather simple, but
a lot of this gets clouded because you have this so-called new innovative instruments which leverage on a certain pool of money or assets and then really go into derivatives and so on. And each of them, as they're removed from the real economy, it becomes more and more difficult to correlate the two. And at the end of it, you risk the real economy for that so-called instruments you've created.
Yeah, you have different problems. One problem is that the financial system that should serve the economy may go in another direction to serve itself.
Which is what is happening now.
Okay.
Appears.
Yeah. The point is, instead of helping to create wealth, in this way, it's going to try to extract wealth.
Redistribute the wealth.
Yeah, in its favor. Okay. But in this way, the game is much wider, because also the so-called real sector go into the same game. In the last years, we have seen a lot of non-financial firms going into the speculative game. Okay? Not making real investment, but financial investment. So, you have a distortion of the primary duty of the financial system. The innovations that are made, in part, are not innovation, because from the tulip bubble on, we know a lot of things. But in reality, many of these instruments are just mathematical exercises made by people with a degree in physics and not in economics. They do not understand anything of economics. Okay, they make this type of instruments, and there are people in the same firm, financial firm, who do not understand what the other have done, and they go and sell. Okay, the result is the people who produce do not understand the economic consequence. The people who sell does not understand what he is selling. Obviously, the people who buy does not understand what is buying. Very often it's said that only people with a PhD can understand. No, it's not true. People with a PhD cannot understand the consequence of one new instrument if I do not give him another information, how much of this instrument I create and how I distribute it. Because this is a problem. In the whole world, 1 billion of junk bonds is nothing. Okay? They fail, nothing happens. If you multiply and make 100 trillions, that's a big problem with the same instruments. Okay? But the people who create this instrument does not know at the beginning how much of this instrument will be created. This is a very important point. The other important point is, this is, for instance, the problem of the AG in the insurance company that failed in the United States, because at the moment in which the party is very fine, you can gain a lot of money, you do not distribute, you concentrate. So, successful instrument does not obey to the first law of finance to have a differentiated portfolio. Okay? then you do not know what happens in terms of the total value you create. Because, as you said, you are creating a pyramid over eventually $1 of real asset. Okay, you create all this pyramid, several layers with a big liquidity leverage, because that's what we have seen in this crisis, is the liquidity leverage, because you create trillions and trillions and trillions of nominal values in this market, or not market, because many are over-the-counter instruments that are not traded in the markets. And then, in the old times, you had the bank money that was at the base. Obviously, the banks are in the same game. You have not an independent source of liquidity. Then you are only with the liquidity of the central bank. What happened? The central bank intervened, multiplying their balance sheets. But it cannot be enough, because the balance sheet of the central bank cannot in a few days go from 1 billion to 3,000 trillions. Okay. So when the balloons goes down, you have very little things to do.
What have the systems learned from the failures? Do you think any change has taken place, or do you think it needs more such shocks before, or a political movement to really reorient the way the financial system is moving?
I do not think that we must think of the system in the sense of the private system to learn something, because they after money. Okay, yesterday, today, and tomorrow. Okay, so the problem is how much the authorities have learned. What are the lessons that they have learned from the crisis? My opinion is they also now do not understand what happened. That's the point.
They still haven't understood.
Still do not understand. Still, I don't want to be too harsh, but I think that fundamentally they have not a good theory. They make models that fail and say, oh, this model failed. Yes, I changed something. Okay, now it's working. After 1 year, fails again. You must know that the central banks use models that do not include the financial system. The central banks
do not include
the financial system.
Okay.
Central bank looks at the financial system by definition as its own model of interpretation of the economy, and the model does not include the financial system. Very good. That's the story.
So, future crisis and ultimately political movements have to correct. Society has to correct finally the regulator, because if the regulators do not correct the financial system, then they are the ones in need of correction.
Yeah, I think we must go for simplicity. Ask very simple questions. What do we need? Not what they need. What do we as a society need? Okay, we need that a bank, as in the old good time, collect my deposits, and then look very well after the merit of the people who go to the bank to ask loans. This is what we need, basically, okay? This is what the current regulation and Basel III is, from this point of view, even worse than the one before, because it goes to the small banks who make this type of activity, because in Europe, in the United States, I do not know here in India, but in Europe and United States, the small banks make this type of activity, and the application of Basel III makes it difficult to go in this way, because they must follow the guidelines. And in these guidelines, you have not a qualitative appreciation. You are not looking in the eyes of the people who comes to you asking money, asking for loans, okay, for a loan. These guidelines, because you must put numbers, okay, and there are a lot of small banks in the United States that are very contrary to the application of this method, just because it is contrary to the relation of the customer relation, long period customer relation they have with the small community in which they live.
Good, thank you very much. It's been a very interesting discussion, and it's also interesting to watch that some of the political movements have started talking about community banks, supporting community banks, and so on, as a counter to the kind of financial collapse that has taken place. Let's see how that goes. But at the end of it, it is not the regulators learning from the banks, but society teaching the regulators the way it should be. That means at the end of it, politics of it has to be set right. Thank you very much.
Take care to you.